Hello, this is Jeff L. with L Group at Amberell Realty. It is the middle of January 2026, and I'm bringing you our year-end 2025 market summary and our 2026 projections to help you understand the impact on your existing real estate assets and future moves. Sorting through the noise and simplifying the data. When it comes to Tucson real estate, the numbers tell a story. Let's break down the latest market trends so you can make an informed decision about buying or selling in 2025. At the national level, 2025 felt like a year of monitoring the Fed's every move. Will they cut? Won't they cut? Then we had the government shutdown, which eliminated almost 2 months worth of economic data. In the end, we still closed out 2025 with 3 quarter-point rate cuts in September, October, and December. So will we see another cut in January? It's not likely, and most experts are projecting no more cuts at the Fed level until Chair Powell is replaced at the end of his term. And after all was said and done, we started 2025 with mortgage rates around 7% and ended the year around 6.2%. And just as I was about to record this video, on January 8th, President Trump announced he's directed the federal government to purchase $200 billion in mortgage bonds, which are more formally known as mortgage-backed securities. This announcement caused an almost instant drop in mortgage rates to 5.99%. The benefit to mortgage rates was somewhat short-lived because the labor statistics were released shortly thereafter, and that told a somewhat concerning story. The U.S. added only 50,000 jobs in December, bringing the total for 2025 to just 584,000 jobs. These are numbers everyone will be monitoring throughout the coming year. The other data we continue to watch is inflation and the 10-year Treasury yield. Inflation in 2025 has been a mixed bag. After peaking early in the year around 3%, it ended the year at 2.7%. The 10-year Treasury yield has remained stubbornly above 4% due to persistent inflation concerns and government debt issues. On the positive side, the mortgage spread, the difference between the Treasury yields and mortgage rates, compressed from as high as 2.65 percentage points in April to just under 2 percentage points by the end of the year, which is actually closer to historical norms. So here's my take on what to expect. Existing homeowners and new home buyers are finally coming to terms with the fact that we will not see rates that start with a 3 or a 4 again. So psychologically, rates that start with a 5 are going to make a huge impact on consumer confidence and dramatically increase buyer activity in 2026. If you're considering a purchase, it would be a good idea to start a conversation with us now and engage a lender so you're prepared to act when rates do dip. All right, now let's bring this home to Tucson. How did our local market perform in 2025? In December, the median sales price came in at $353,630, down 1.8% from December 2024. This marks a slight cooling after we hovered around $365,000 for most of the year. This is usually normal for the last months of the year when home buyers are busy shopping and traveling and not focused on home buying. Looking at the full year, the median sales price for 2025 was $362,000, down slightly from $364,000 in 2024. The average sales price came in at $441,000, up from $434,000 in 2024, indicating that while typical homes saw moderate price declines, higher-end properties held their value. The average price per square foot remained steady at $228, exactly matching 2024. This tells us that on a per square foot basis, Tucson real estate held its value despite the challenging rate environment. Strategic advice for 2026 for home buyers? Here's my take. We're in one of the best buyers markets we've seen in years. Yes, rates are hovering around 6%, but remember, rates have been historically normal at these levels. What's different now is that you have negotiating power, more inventory to choose from, and homes are actually sitting on the market long enough for you to make an informed decision. With this new mortgage bond initiative potentially pushing rates down towards 5.75%, 5.5% over the coming months, you have a clear path ahead to either purchase or refinance. The best opportunity would be to lock in a home now while you have less competition and more negotiating leverage before those rates drop. Then refinance later when rates do drop. Waiting for the perfect rate means competing with everyone else who's doing exactly the same. And here's the kicker. If rates do drop significantly, you'll face more competition and likely pay higher prices as demand surges. We've already seen this pattern play out twice in 2025 when rates dipped temporarily. Let us show you these opportunities before they disappear. For sellers, if you're thinking about selling in 2026, understand this. We're not in a bidding war market anymore. Homes are selling, but they need to be priced right from day one. The data shows that properly priced homes, those advertised by experienced agents who understand current market conditions, are still closing within 2% of asking price. Some are even selling above asking price. Here's what does not work: testing the market. You can't throw a high price out there and see what sticks. With days on market increasing and buyer scrutiny higher than it's ever been, overpriced homes sit and become stale. If you have a sign in your yard and strangers walking through your house, be serious about selling. Price it right, present it well, and you will get results. Here's the bottom line for 2026. We're looking at a balanced market where rates are likely to trend down, inventory increases, and positioning yourself strategically, whether buying or selling, is more important than timing the market perfectly. The opportunities exist for those who are professionals working to find them. As always, if you want to discuss any of this information we covered, or if you're ready to make a move in 2026, give us a shout. We are a member of your trusted professional advisors, and we're here to help you navigate this market with confidence.